Welcome. My name is Kelly. I'm joined by Simon Buckingham. We are in today's Property Pulse Fireside Chat. Welcome to the topic of the day. And the topic of the day is negative gearing going to change?
Obviously, there's a lot of noise in the headlines generally right now, but one of the questions that's top of mind for investors at the moment is the federal government going to muck around with negative gearing in the coming May budget? And there's been a bit going around about that. Now, for the uninitiated, what is negative gearing? Very briefly, negative gearing is the idea that if you are making a cash flow loss, so you've got more expenses on your property, including interest, overheads, and all of that. If you've got more expenses than you're getting in rent, then you're making a loss. You can potentially deduct that loss against your other income to reduce your overall tax bill. So if you own a property in your own name, you're losing $400 a week in all of the net costs on that after the rents come in, that you could take that and use it to reduce your taxable income at the end of the year. So that's negative gearing, seen as a way of potentially making it easier to invest in or own a property. It's not just applied to property, though. You get to deduct those sorts of costs on other asset classes and businesses and so on as well. That's negative gearing. What's the rumor mill saying at the moment? Well, it's been reported in the headlines recently that the government and Treasury have been modelling a few potential changes to the tax deduction that is negative gearing. And there's been no explicit statements or announcements from the government to say that they have got a policy going into the May budget. The typical response, I think, when they're put on the spot about this is, our tax policies haven't changed, but we're open to looking at the options. So kind of a foot in each camp.
Well, again, that goes into, what are they really doing? And we are of the opinion that they, as many others are, they are leaking information out, waiting for a reaction or response from the media and the public around whether it's a good idea or not. And depending upon which of the ideas are liked the most, diminishes the votes they'll lose, and therefore that's the one they'll go with.
And there could very well be a kernel of truth to that. That does seem to be what they did when they first started floating potential changes to the CGT.
Well, it is better than what they did leading into the election in 2018 when they said, we're going to do this. And then they said, no, you're not. And they didn't get into power.
Yes, but of course, they do this time around. They do potentially have the numbers in Parliament to pass significant changes to tax if they feel they've got the courage and enough support to do so from the public. So the latest rumor that's doing the rounds is that what's being modeled is a potential 2-property limit to negative gearing. So if you're investing in property, you might be able to get negative gearing benefits from the first 1 or 2 properties in your portfolio, but any properties, investment properties you hold beyond that, wouldn't qualify for negative gearing. Now, that sounds like an administrative nightmare for the tax office, potentially, but if that was the case, then it's worth us having a look at, well, what might that mean for us as investors? What might that mean for the property market? Now, again, there is no real clarity here. Nothing's been confirmed. We don't even know at this stage whether it would potentially be grandfathered. So what does that mean? It means that if you already had a property and you were getting negative gearing benefits, that nothing would change.
See, now you're talking administrative nightmares, Simon. If you had a certain number of people who had properties and it was a dated-based property that at this date after I purchase this can't get negative gearing, so I've got some that are negative gearing, I've got some that are not negative gearing, you reckon 2 properties is a tax burden? I reckon grandfathering 2 million people who already own property and the next generation of people who are going to buy property, you're talking a whole department just for the purpose of managing that.
Government efficiency at work, obviously, and you're absolutely right. Like, there's any number of layers of complexity, and none of the detail obviously has been discussed or clearly
it's all
articulated or anything like that. But you could also have a situation where, okay, let's say I've got a portfolio of 5 properties. They've all got different cash flows, they've all got different expenses, they've all got different rents. which two do I pick? Do I get a say in that? Is it just the first two that I ever bought? Can I mix and match it each year and go for the ones with the biggest negative gearing benefits?
I think that could easily be grandfathered. Well, all right, maybe. Actually, there's a number of models that I think could possibly work. If you've already got 5, let's say, would they grandfather it? No. You're right. There's your complexity, because that wouldn't work. What they might do is limit it to 2, as you're suggesting. If they do limit it to 2, how would they do it? As you would say, Simon, which you pick, well, you pick the ones where you're going to get the most tax benefit, full stop. It's not date related. It's as of this date, you're going down to 2, and we're going to edge this in over a period of time. So I think it's not going to be a snap on, snap off. I think it's going to be a transition over time to allow people to adjust their portfolios accordingly and manage their finances.
Yeah.
But you've got something around, which I found very interesting, in New Zealand, where they did snap on and snap off.
Yeah. So this comes out of the notion that, why are you doing this in the first place? And the argument being, well, we're trying to make housing more affordable for the owner occupiers, and
a wealth generation gap.
Yeah, address generational inequality and a perception of favourable treatment for investors, which is causing more of a concentration of property buying for investment rather than for accommodation, for living. Now, New Zealand went down this path, and if you want to see a case study in what happens with a snap-on, snap-off kind of an approach, going perhaps even further than what's being talked about here. Back in early 2021, the then Labor government in New Zealand rolled out a policy which was to remove interest deductibility on all investment properties. So we're not talking grandfathering or anything like this. It was a snap-on. If you hold investment properties, if you're buying investment properties, you can no longer deduct the interest at all. So it wasn't even negative gearing. It was about, from a tax treatment point of view, even if you were holding that in a company or a trust, any of the interest costs were no longer a tax deductible expense. So you're paying tax on money you don't actually earn, regardless of the ability to then offset that against personal income for negative gearing benefits. So that was the policy they rolled in 2021. Now, what was the impact of that? Well, you did see a shift in the volume of property investors in operating in the market. So before this came in, roughly about 20 to 25% of new loans were going to investors, new mortgage commitments. That dropped to below 20% after that came in. And you did see investors taking a bit of a back seat, and the relative presence of first home buyers increased as a result of that. So it kind of shifted the balance a little bit.
There's a certain amount of stupidity associated with that, but not being able to deduct an expense in running a business.
It flies in the face of ordinary business accounting. For starters, you have an expense that's reducing your profitability, but you're being taxed as if you didn't have that expense on a profit you never made. It doesn't make a lot of sense. But regardless, that was the experiment that the government at the time in New Zealand decided to do. I might just show you what happened to property prices. Does messing about with this stuff actually improve affordability? Did it improve affordability in New Zealand? And what we can see here, so I've got a chart of the house price index, as they call it in New Zealand. You see property prices were gradually moving up over time, and then as you came into 2021, they really started to lift. Right in early 2021, the interest deductibility rules change in New Zealand was announced. So this idea, if you're investing in property, you're going to lose your interest deductibility. That was announced in early 2021. It came into full effect late 2021 as you came into 2022. You had a peak in property prices and then it fell. And you might look at that and go, ooh, so changing this stuff can potentially cause prices to fall. But really, prices were already on a steep uptrend at that point due to a number of factors anyway. And other stuff was going on at the same time. You might remember we had a pandemic. Coming off the back of that, we had inflation. We had a rapid series of rate rises, and New Zealand was no different. So interest rates actually went up quite swiftly, and that seems to have been really the main driver of the slump in property prices over there. But from an affordability point of view, let's take a look at this. This is where prices were as the policy was brought in. They were at this level. They went up, they fell back down. By the time the policy was actually reversed as a result of a change of government a few years later, so the new government came in and said, this is a stupid policy, we're removing it, and fully reversed it, property prices were back really where they were even before the policy was introduced. So the net effect of introducing that policy on affordability was a couple of years of disruption, and then prices were still where they were. It didn't improve affordability at all.
But the disruption was on the basis of other factors, less so than, admittedly, there were less investors interested. But again, you increase interest rates, less investors are interested in when interest rates are going up anyway. So there's a whole, well, what was the trigger for the inactivity? Was it actually this policy or not this policy? And then if you bring that over the ditch to here, you go, well, what will be the play out ultimately here for affordability and the number of investors in the market?
Yeah.
And there are big questions and doubts about what impact it'll actually have.
Exactly right. So I think there is significant doubt as to whether tinkering around the margins like this and playing around with however many properties someone could negatively gear or not, whether that's realistically going to make a difference to affordability, whether it's realistically going to address any level of intergenerational inequality, or we're just playing at the fringes because it's not addressing the fundamental issues that are actually driving housing affordability in this market.
Which is supply.
Yeah, exactly.
Which leads us right back to the war. The impact of petrol, the cost of materials, the cost of production of materials, the cost of shipping and transporting of materials, the big bilge happening right across the country causing a shortage of labour. They've got no impact at all whatsoever on the ability to build a house, as far as I can tell. That was supposed to be horribly sarcastic.
But, we can argue back and forth all day about to what extent tinkering with things like negative gearing is actually going to improve the situation for first home buyers trying to get into the market, or affordability. You could argue, if you take away negative gearing benefits, then how's that helping with rental stock? And we've got a rental inflation issue in this country as well. So there's arguments on both sides, and there'll be people who are adamant that they're right on each side. From our perspective as investors, it doesn't really matter who's right or wrong. We just need to anticipate what might change and look at how we're investing and how that might change our strategies, or how we might manage our own risks in this kind of environment.
What do we need to do, Simon? I mean, if you've already got a portfolio and you're taking advantage of negative gearing opportunities for you, fantastic, great. Obviously, it's a long-term hold. You're looking to wear this out over a period of time. What if things changed? What if there was a requirement for you to reduce the negative gearing volume in your portfolio? And our encouragement would be to start to, as Simon likes to say, I think it's a brilliant set of words, stress test your portfolio about the properties you've got. If it was that you were to be inspired to sell a property, let's say, which one would you sell? And why would you sell it? And which one would you keep and not keep? So that then it might be merit in you doing some investigation around what's happening in the markets of which you hold your properties.
Yeah, I think you're exactly right, Brennan. The idea here is not to lose sleep over what might or might not happen and what the policy might or might not be. You can't know whether anything will change yet, or the details of that. It's not there. So let's not get caught up in the rumors, but let's just go, okay, assuming it does come in and suddenly I can only claim negative gearing benefits for one or two properties that I might hold. In terms of my own portfolio, what does that mean? Where does that leave my cash flows potentially? As you say, Brennan, stress test where that leaves you. Is that a manageable situation? Is that an unmanageable situation? Does it put too much financial stress on you? And then look critically at what you already do hold. Do you have any deadwood in the portfolio that's not performed? Because frankly, if you've got
which ones, if you were to sell, would you choose to sell first, and why?
Correct. If you've got an underperforming asset in your portfolio now, it's not likely that it's going to suddenly perform any better if a policy like this does, in fact, come into play. So what actions can you take preemptively now to maybe cull some of the deadwood in the portfolio so that you're armed up to invest in new opportunities moving forwards.
Are you saying, Simon, that we do need to cull now? The answer is no.
Well, no, I'm not saying go sell.
No. The intent here is for you to just do some analysis and be happy. Because if you think about it, and if you look at the New Zealand example, the major influence on prices and the volume of investors was not the policy change, it was interest rates. And again, you go back to the conversations about the war, current inflation, current interest rate conversations, that's likely to have more of an impact. Interestingly enough, and going back down my conspiracy theory rabbit hole, you could have the government turn around and go, look, our policy does work. Interest rates went up, nobody bought stuff, prices came down, our policy works. But no, that would, anyway,
yes,
I digress.
Disastrous management of an economy is a great way to push down property prices.
That's right. My point, though, is interest rates will impact. So you'd want to stress test your portfolio anyway. What if costs go up? What if I couldn't take advantage of what are the benefits that exist right now? And how does that play out?
Yeah. So a couple of questions in the chat that we should probably address. Do we feel this will overall increase selling prices or decrease prices? Well, if you take some investors out of the market as a result of something like this, or if they're more hesitant, obviously that's demand suppressive, not increasing. Whether they get replaced by owner-occupiers, only time will tell. Obviously, it didn't make a big difference to prices over the medium term in New Zealand when this sort of tinkering happened. Any impact would be relatively short-lived before the market readjusts.
I say there's not going to be a lot because owner-occupiers aren't going to sell under these circumstances. They're not triggered to do anything. They'll stay. People will still have to move and buy and sell. Yep. The only thing that will be the demand suppressant might be enough to slow a rate of growth a bit. It might be enough to take something, it's like all of Melbourne's currently in decline. It might contribute a little bit to a slightly steeper decline. Queensland, for an example, currently in reasonable growth, might not grow as fast. Do you see the impact? It's really nominal, but the prices you're not going to see a significant shift on. So no, I don't think it'll have a significant impact.
Yeah. Do we think that rents will go up to cover the additional cost or the lack of deductibility? That is a possibility. Over the ditch in New Zealand, well, rents just continued to go up over that period. Now, was that purely as a result of this? Well, you could argue housing shortage.
Interest rates, correct.
Exactly. So there's a number of factors there that can be difficult to separate.
Investors today are comfortable. Investors invest on the ability to be able to sustain. That's the broad essence. Yeah. If I can tolerate a certain negative gearing component, then I will, then I'll go and buy one. If I can't tolerate, I won't. If I don't have the benefits that allows me to get the current rate of rent and the current value as a tolerable amount, then I won't buy right now, I'll hold off. So what you'll see is, yes, you'll get more owner-occupiers, yes, you'll see slightly less demand, until such time as a new equilibrium exists, such that rents are more expensive, and it can tolerate the out-of-pocket expenses. And then you'll see right back where we are, where investors are back into it saying, cool, let's play this game again. The differential exists, so I can afford it, and we'll continue to use property as a wealth creation mechanism.
Yep.
And that's what they're attempting to change or affect.
One other question, what was the highest interest rates have gone in Australia since the 2008 financial crisis? I don't know that off the top of my head, but we know that
I think it was 8%, which is the one that was recently.
Retail interest rates went up over 8%. Fixed rates went up over even 9%. So we're some way under that at the moment, with typical lending rates sort of in the high fives, low sixes right now. So
back in my day,
back in your day,
luxury. We had 18% interest rates back in my day. You poor, hard done by pedals. No, this was back in the 80s.
Okay, boomer.
Anyway, Simon,
so
last words.
What to do? So obviously stress test portfolio. I mean, I've never been a big advocate of negative gearing as a primary wealth building strategy if you've got a shorter term horizon in terms of what you're trying to achieve.
I think as a long-term strategy,
exactly.
if you are starting young, it's brilliant.
Shorter term. Yeah, exactly right. It's great to have tax benefits, and I would always treat them as a bonus, though, rather than the reason to do the deal. So Absolutely. If you're investing for negative gearing benefits, then maybe this is another prompt to rethink the strategy you're applying. Look at strategies that don't rely on tax deductions to make money. And one thing which would be very interesting is if this comes in is we'd be likely to see positive cash flow properties becoming much more highly sought after as well, if people aren't really getting so much of the after-tax benefit from something like negative gearing. So that'll be something to watch moving forwards. There's a lot more going on than just this, though, obviously. And I think the bigger impacts on the market are more likely to come from the supply side and inflation side impacts of things like the Middle East conflict at the moment, the oil crisis, the supply side impacts that we're going to see there. But Brendan, I think that's a topic for another day.
It is indeed. That's a whole other rabbit hole we're going to go down.
So before we wrap up today, though, if you are one of our newest members, welcome aboard again. And do make sure you've filled out your profile on the community so that you can make those valuable connections with other like-minded investors around you here. Do make sure that you check out the upcoming event space, RSVP for these sessions and other sessions that are coming up so that you get the reminders, and check out the replays, of course, because there's a ton of very valuable information already at your fingertips. But welcome aboard.
Guys, we wish you the very, very best for the week ahead. And until we meet again, which will be next Thursday, invest wisely. See you guys.
See everyone.